But yeah, extrinsic value pricing basics. I think this is one of the most important things to continuously revisit as we get deeper into option strategies, we get more shallow into overarching concepts. But this is really important, especially when it comes to estimating how pricing could be given a move in your direction, or really just estimating, like, if I want to take a directional shot, really what is my practical expectation for this strategy? And if you're playing for the upside with calls relative to the downside with puts, your multiplication possibility will always be higher with the call side relative to the put side. And we showed that in Tesla. We had a really good example in Tesla looking at out of the money calls versus out of the money puts. And if you get the out of the money move to at the money, how does that affect the price of that option? And it all comes down to the Black-Scholes model. So that's what we're diving in today.
Yep.
All right. So the Black-Scholes model, how are options priced? The Black-Scholes model takes certain inputs and spits out an options price. One of the biggest misconceptions is that implied volatility is a number that we just have, but really it's a number that we derive from the other inputs that are thrown into the Black-Scholes model, and then we solve for it. So when you see changes in options prices and you see changes in implied volatility, it's really the change in implied volatility is because of the changes in option prices. It's not the other way around. It's kind of weird to wrap your head around, but hopefully this segment will help a little bit. So the Black-Scholes model does include inputs for strike price, current stock price, time in terms of days till expiration, the risk-free rate of return, and volatility that we get from the Black-Scholes model. So higher price stocks, higher price options across the board. This is really in the lens of extrinsic value, I think, is the best way to look at this, because intrinsic value is intrinsic value. It's static. It doesn't change from stock to stock based on implied volatility. It changes from stock to stock depending on where your strike is. So if you're trading Airbnb and your strike is 10 points in the money, your intrinsic value will be the same exact intrinsic value as if you're trading SPY and your strike is 10 points in the money, or Mara and your strike is 10 points in the money. So intrinsic value is constant across all products. Implied volatility and stock price is what changes the extrinsic value of the different landscapes that we look at. Further out of the money options are going to be lower priced than at the money options. Now, and this is because this is from a lens of extrinsic value. So why is this? I think the easiest way or most simple way to think of this is just looking at uncertainty of an option being in the money or out of the money at expiration. If the certainty is high that the option will remain out of the money or remain in the money, then through expiration, then the extrinsic value is going to be low in that option. Now, you could be looking at out of the money options. You could also be looking at in the money options. In the money options that have very little extrinsic value are going to be expensive options because they have a lot of intrinsic value, but the certainty of that option remaining in the money is high. Just like a far out of the money option with low extrinsic value, the certainty of that option remaining out of the money is high. So thinking of it from that lens, I think, makes it a little bit easier in terms of explaining why extrinsic value is going to be highest at the money, where the uncertainty of the option being out of the money or in the money is highest as well. Some other pricing factors: skew, fat tail risk. This is going to be very subjective from stock to stock. So you could be looking at Airbnb, you could be looking at DraftKings, you could be looking at Tesla, you could be looking at SPY, Qs. All those products are going to have very different skew landscapes. And that is based on where the market perceives velocity of risk to be. Sometimes you'll see products like SPY and the Qs that always show you put skew. Sometimes you'll have Tesla that sometimes has call skew, sometimes has put skew. We've seen that kind of shift the most between different products that have that ability to shift between call skew and put skew. So always interesting to see. Doesn't mean the stock's moving in that direction. It just means that that's where the risk is perceived to be for a big move.
Yeah, and skew is also more skewed in terms of like I should say more random in a shorter duration, just because of all the inputs that go into the Black-Scholes model. When you have less time, when the actual activity in the strikes is much more concentrated towards at the money, that typically happens in shorter duration. So you can have skews that are independent of longer durations in shorter duration options. So a lot of times sometimes in something like a SPY or Qs, you might see the one-day options have call skew just because there's a binary event coming, or there might be increased activity on that side going into an event. The skew doesn't have to be the same across all expirations. You typically do see, something that has put skew probably has, flat or no skew in its shorter duration, but you can see changes in skew just based on earnings events or binary events that come into play for those options. And again, that's just an effect of option pricing coming into play there.
Mm-hmm. Lovely. Mm-hmm. Here we go. And now we're cooking with gas.
Yeah. So this is just a general look at extrinsic value relative to a stock price, right? So if you have a $50 stock, if the volatility is the same, a stock that's $100 would just have double the extrinsic value at those same strikes. So it would be a linear type of bell curve if you went from a $50 stock to a $100 stock or a $150 stock, assuming volatility is the same. Of course, you're going to have changes in volatility and changes in extrinsic value, with that change in price, because the one of the inputs gets much bigger, right? Mm-hmm. So an option that is on a stock that's a $50 stock, an option at the 10 strike is going to have more value than when the stock is at 150 and you're looking at that 10 strike. And that's because, the inputs change here.
Yeah. And that's why with a few degrees of certainty, if we are looking at a stock that has $50 or it's trading for $50, and we look at a different stock that's trading for $150, and the implied volatility is exactly the same, and the expiration we're looking at is exactly the same, the at-the-money options is going to be 3 times more, just because the one input that is changing is the stock price.
Yes.
You could also look at it in a different way, and we've done this before too, where we'll look at 2 $50 stocks, and we'll see one with an implied volatility of 30% in January. We'll see one with an implied volatility of 60% in January. And the same thing could be assumed. You would assume that if the stocks are the same, but the implied volatility is twice as much, then the extrinsic value for those out of the money and at the money strikes that we're looking at would be twice as much, because the thing that is changing in terms of the environment you're looking at isn't the risk-free rate of return, it isn't the stock price, and it isn't the expiration, it's the implied volatility. So, and again, the implied volatility is not an input, but it's something that we derive from the option prices. So there's a lot of different ways you can look at this, but from a general standpoint, if you have a $50 stock and you have a $150 stock and everything is the same, the extrinsic value looking at different strikes would basically be 3 times more.
Yep.
All right.
So getting into the option prices themselves, when you think about all the inputs, right? So days till expiration obviously has an influence. Risk-free rate now kind of comes into play. That has an effect on the option price as well. But really, the biggest influencer of the options price, the actual value of one contract from one stock to the other, is going to be the stock's price. The higher priced stock going to have higher priced options, all else equal. What comes into play here with option pricing and why there's kind of a difference in risk reward when you're playing the downside versus the upside is that you have a gamma effect that goes in your favor with upside plays. And that's because as stocks go down, all the options become less valuable relative to the higher priced stock. So if you have a $150 stock and and you buy 100 strike put. That put, even if the stock goes to 100, is going to be trading for less value than a call if the stock goes from 150 to 200. It's the same $50 move, but just because the one of the inputs, which is stock price, changes and goes much lower, that's going to have a bigger effect on the option. Of course, there's other things that come into play, but all else equal, the stock price is going to have a much bigger effect. And that $50 down move is not equal to that $50 up move. And that's because of the negative gamma that gets associated with the option itself. So think about it from a delta perspective, and gamma is the rate of change of an option's delta. So if those are the same delta options, the stock's trading at 150 and the 200, there's no skew. The 200 and the 100 strike are the same delta. Let's say they're 10 deltas. If the stock moves to either of those strikes and you go to the stock moves from 150 to 100, and now you have 50 deltas, it's right at the money of a $100 stock. That is a lesser notional value than 50 deltas of a $200 stock, right? So it's double the exposure, and that's kind of the effect of that negative gamma, and I put that in quotes because you still have positive gamma. It's just that the price is lesser than what you started with. So all else equal, an increase in the stock's price is going to have a bigger effect on that option relative to the decrease, even though you're getting the direction right. So as stocks go up, all the options will increase in value. Calls will increase more since they are now based on a higher stock price. So this is why, if you have out of the money long call, it's going to increase more than an out of the money long put, all else equal, just because of that change in the stock price. The puts increase in value is going to be relatively lower because of that higher price stock for that same price movement.
Yeah, and if a stock is going up, if you already sold the put is going to lose value.
Of course.
But this point here is the most important thing. Comparing a 10-point out of the money put at 50 versus 100. So if you're looking at an out of the money put that's 10 points out of the money on a $50 stock, let's say it's trading for $1, and then you look at a 10-point out of the money option on a $100 stock, it's going to be trading for more than $1.
Yeah.
And that's the relativity of where the stock price is and where your short put is. Not necessarily selling a put and then watching the stock rise. That's not what we're talking about. We're talking about different stock prices and how a 10-point out of the money or just an out of the money put in general will have a higher price than a lower price stock because of the increase in the stock price. So all of this kind of helps explain why we choose certain strategies over others. So I think for us, the most applicable examples that we could give would be why we say if we're going to trade the upside on UVXY or VXX, we're just going to buy out of the money calls. Mm-hmm. Now it goes against everything that we talk about with short premium trading, but why is that our answer if that's how we're going to trade it? Because we know that volatility stocks they rally in a big way. That helps us, number one. That's going to really increase the stock price, which helps increase the call options like we're showing here. We also know that when products like that rally, so does the implied volatility of that product. So we now have a stock price that's rapidly rising, which helps the extrinsic value of the option. We have implied volatility rapidly rising, which helps the extrinsic value of the option. So when you compile all these things, you can create a logical reasoning to do something that goes against what we're talking about because we have all these inputs, we know what's going to happen, or we can estimate what's going to happen, and that might be the strategy that we go with. That doesn't mean it's a high probability strategy. That's not what we're saying. But that is, like, if you're trying to make the most bang for your buck, trading the upside for volatility, that could be one of the ways to do it because you know how these things are going to change based on X, Y, and Z that we're talking about. Now, on the other side of things, I think this also explains why if I were to pick one strategy to do the rest of my life, it would be a short put, because not only do we have the skew in SPY giving us more premium to take the risk on the downside, But like we show here, if the downside risk is actually realized, that short put, if you exclude implied volatility increases, that short put isn't going to really increase in value all that much. It's not going to like explode out of proportion in terms of extrinsic value.
And that's because the price of the underlying decreases, and that's the biggest part of the Black-Scholes model and into option pricing. And this next visual explains exactly what Mikey's trying to say here, in that if you start at 100 and you get a $50 move, a 50-point move in either direction, those calls increase a lot more because the input of price gets much bigger. Now on the downside, of course, your puts are going to increase in value. You're short a 50 strike short put and the stock's moved 50 points, but it doesn't explode in the same way a call option does, and that's because the notional exposure of that option decreases with the price of the stock. The same 50 delta option on a $100 stock is $5,000 worth of exposure, whereas the 50 deltas on a $50 stock is only $2,500. So that value changes just based on the price of the underlying.
Yeah. And when we did this example with Tesla, we looked at out of the money options in Tesla. When Tesla went from 750 to 1250, we looked at buying calls, or just the change in value of the call options, really, from that rally from 750 to 1250. And the return on the option was like 700%, 7x from what it was. We also looked at the fall from 1250 back down to 750 with out of the money put options. And the change in the out of the money put options was only 2 or 3x. So because the stock price is changing in a really big way to the upside, your calls, even if volatility is contracting, your calls are going to multiply by way more of a multiple than out of the money puts. Now, this also ties into AMC and GME, and why we saw a lot of people saying, AMC, GME, they're rallying, they're going crazy. We know that they're going to come down in price. But we saw people lose money with buying out of the money put options for this graphic exactly.
Yes.
Not only did the stock price go from 150 down to 20 or 30 or whatever the change was, but implied volatility on the way up was exploding, which is increasing the extrinsic value of all options, even the options that are super far out of the money. When the stock price contracted in price, so did implied volatility. You saw implied volatility go from 300 or 400% down to 100 or 200%. That just destroyed the value of the out of the money options. Even though you saw 50 strike options when the stock was at 100, you saw the stock go from 100 to 50, but the options lost value because of the drastic change in the stock price, which is the input in the Black-Scholes model that really matters a lot, but also the implied volatility. So we saw plenty of people, I remember this distinctly.
We got 100 emails on that.
Like how could I have lost money with these out of the money options even though the stock price dropped 75%?
Yeah.
And that's why.
Yeah, that's exactly why. And this is also a reason why we prefer to do like if you're trying to get short something and you want to do it via options, we look at zebras or put diagonal spreads where, even you're selling that tail event, and that tail event, of course, caps your downside potential. But if you're directionally correct, it doesn't go against you all that much. You have to have that sort of decay component with you, because if you're wrong on direction, now you get whacked on both sides. Not only does the input, reduce the price of the option, but you have no decay component there as well.
That's it.
It's a good one.
Hopefully,
I like that visual.
Yeah. Hopefully that tandem rant helped. Even if it's just an understanding of how these options prices move. So really, when Nick and I are looking at things and we're just estimating like this could go to this could go to that, it's not because we have this profound understanding of the Black-Scholes model. It's actually the opposite. We're just simplifying things, and we have this visual in our head when we have the ability to estimate, if, and Airbnb is the great example, if the at the money options in January right now at the 100 strike are trading for 10.50. If the stock price goes to 110 quickly and time doesn't really change too much and implied volatility doesn't contract in a big way, the stock price is going to be 10% higher relative to where it is now. So I could safely assume that if all other factors are equal, that my 10.50 option I'm seeing now at the 100 strike, maybe it's trading for $11 or $11.50 or something like that at the 110 strike, which in this case would result in a net positive winner for me because my debit paid is only 10. So these are the estimations we're making.
The estimation is the key word because we don't care what the exact price is.
Right.
It's just understanding this dynamic of how option values change and how extrinsic value changes that gives us the confidence to trade. You don't need to know exactly what that 50 strike put is going to go to because if if you understand what changes in extrinsic value or how extrinsic value changes, you know that it's going to increase or decrease, and you can estimate that it'll increase or decrease by a certain amount. You don't need to know that exact to the penny value. It's you'll be wasting too much time trying to figure that out.